which is really weird. Like dating world does not work like it's a free for all, right? In a way. But like in the business world, there are pedestals, there are networks, there's a way to negotiate, navigate the room to get better deal flow.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have Lane Kawaoka. Lane currently owns over 10,000 units across the U.S. He lives in Hawaii with his wife and daughter. And after quitting his job as a professional engineer with a MS in civil engineering and construction management, as well as a BS in industrial engineering, he is focused on real estate full-time. Lane partners with investors who want to build their portfolio but are too busy to mess with tenants, toilets, and termites by curating opportunities in his deal Pipeline Club, where his investors have personal access to him and know that Lane is personally putting his money on the line too. His Pipeline Club has acquired over $2.1 billion of real estate, acquired by syndicating over $200 million of private equity since 2016. He's returned millions of dollars to investors in distributions, and he reverse engineers the wealth building strategies that the rich use to the middle class via the top 50 investing podcast, The Wealth Elevator. Lane's mission is to help hardworking professionals out of the rat race, one free strategy call at a time. Check out his podcast and his community at thewealthelevator.com, and check out our podcast and our conversation today. Lane, welcome to the show.
Hey, thanks for having me. Hello, everybody.
Yeah, no, I'm excited to have you. I think we're gonna get to talk about some of the trends we've seen here in real estate over the past several years. But in Next Level Income, Lane, we've talked a lot about how do you go from you're in a 9-to-5 job, you want to replace your active income, and I love your story because you've done it. And being an engineer, at least I got an engineering degree on the wall. I passed the test before. I
leave
college.
mine at my parents' house. Yeah. That only makes them happy.
But I'd love for you to share that story because we're going to get into kind of the how with real estate. But I'd love for you to talk a little bit about what you were doing and what inspired that transition for you.
Yeah, so 2007, graduated from University of Washington with an engineering degree because that was the way that I was taught to go to school, study hard. And I was also keen to the fact that I didn't want to go to grad school or get a doctorate, right? Because I know I would have been having to pay that out of my own pocket. So I didn't want to do that. Became an engineer, started to work for the man, and was actually working for the railroad, right, as a construction supervisor management on the management track. And I was able to save like 40 grand every year for the first couple of years. So I saved up 80 grand to buy a house in Seattle, Washington. Yeah. But because I was traveling all over for work, never home, just decided to rent it out. And that's where I got kind of this taste of cash flow. And I was like, whoa, this is cool. And that was 2009. And bought a couple more in Seattle a couple years later. Then by 2016, I had 11 rental properties in Pennsylvania, Alabama, all those flop states with better rent to value ratios, right? Yeah. And then, that's kind of when I transitioned to the bigger stuff, right? Kind of, I think you and I kind of, we're babies of the 2008 decimation of the real estate world, right? And we came.
Oh yeah, oh yeah, wild ride through that period. Because I bought my first property in '99. And it was tough, man. It was like, but I will say, and I think this is a good theme we can kind of touch on, throughout the show, which is real estate does go in cycles. We can go back all the way into the 1850s and watch real estate go up and down, residential real estate, commercial real estate. I think we're going to see, space real estate here. You got the SpaceX IPO. It was a tough time, but like you said, you had that one house, but man, you really started buying at the right time in the market when it still made a lot of sense, especially in residential, to buy properties and do that. But you were doing them out of state. How were you managing those out of state? Did you have a partner that you were buying with, or were you hiring local companies, or were you doing it yourself?
I mean, up until when I was just buy, hope, and pray strategy. I was just buying it turnkey, and I didn't know what I was doing, right? But I was buying it at a decent price, 80 grand to 100 grand. That rented $1,000, 1,100. So the numbers worked back then.
Yeah.
Today, unfortunately, the young guys have no shot at doing that. So they got to do silly
Yeah.
short-term rental properties,
Right.
stuff like that to get the revenue up there. But I mean, I was lucky, right? But 2016, I mean, that's when I kind of started to become an accredited investor myself and
Yeah.
started to interact with other investors and started to kind of learn this, as I call it, the trifecta, right? Like
Yeah.
investing in alternative investments. My foray was commercial real estate, obviously, and
Yeah.
changed since the big undertaking this last several years.
Yeah.
But that unlocks other tax benefits where you cut your taxes drastically and then you run it to
Yes.
infinite banking. And that was
Love
like
it.
what I kind of distilled from all these older
Yeah.
guys that owned a lot of rental properties that were selling their rental properties for syndications and private placements. And I really, okay, this makes sense, right? Like buy rental properties until you're an accredited investor. And then when you're an accredited investor, then you kind of pivot to this.
Yes.
And when you go that, we can talk about that later when you go beyond
Yeah.
3-4 million net worth.
Yeah.
But it kind of all kind of, I mean, I was kind of living it, right? I mean,
Yeah.
I'm not one of these stories of like being in the car. Like, I mean, who wants to listen to those silly stories, right? I don't want to listen to that guy. I want to listen to who's the boring engineer who had a good salary that had
Yeah.
somewhat of golden handcuffs, silver handcuffs. They're not made out of gold, but yeah, that's it took me a while, right? Like 2009, bought the first rental, and then by 2000, a decade later, I suppose, or a little bit
Yeah.
less than a decade, accredited investor, million net worth.
Yeah.
Eventually quit my job 2018 when I made this more of a job. Right?
Yeah. Yeah. No, I love that. And I want to underscore something in your story, Lane, which is something that, we talk about in all our education materials. And we got our new ebook that just launched here. Well, it's launched while we record this, but launched last month when this recording comes out. How to be financially independent, how to be financially free by 40. And I talk about in the book, we can talk about stocks and you listen to these people are like, oh, become basically overnight millionaire. But the way you described it is it's a lot easier, I think. It's harder to accept because you say, hey, this is going to be a 10-year journey, right? I'm going to buy good deals that make sense. I'm going to do it consistently over a period of time. And yeah, it's going to be slow. I always love to say real estate is a get rich slow game. But you lived it, you did it, you were disciplined and did that. How, you were saving, you said initially 40 grand a year. Like what was, just out of curiosity, we say, hey, strive to get to a point where you can save 50%. And obviously it's easy if you start saving 40 grand and then your income's going up and you're not blowing through your income. Talk about that discipline to save and invest. Like what were those kind of early middle years like for you?
Yeah, I mean, my 20s and 30s, I was lucky. I didn't have a wife that spent my money. Like, so get started early before you have to spend your money on them. Hopefully,
Yeah.
that's not you, the one spending your money. But,
Yeah. The
I
ultimate
mean,
hack is you marry a woman who's got, who's making a ton of money and you're like, oh, okay. Like, now I don't have to work anymore. Right. But no, you did it the old
yeah,
fashioned way.
I suppose. I suppose. Not for me. I mean, also, the Think and Grow Rich guy says you're supposed to find a spouse that, like, spends a boatload of money and pushes you to your nth degree. Like, yeah, not for me, bro. Not for me.
Yeah,
Like,
yeah. No, I'm in the same boat as you, man. Maybe it's the engineer in us, but I found a wife who's traditional and she's even more of a saver than I am. She's very frugal. It's so funny. She'll buy, something and she'll return. I'm like, how are you not on like lists that don't allow you to return stuff anymore, sweetie? Like
yeah,
but
you got to get them on that list so they get banned from the store. Right? Like, that's the key.
well, she does. To be fair, Lane, and I look for especially people that know me and my wife. But she's an architect. She's successful in her own right, so she can make and spend her own money. But no, you're right. It's like how do you? But so how did you do it? How did you maintain that discipline? You said, yeah, I didn't have a wife that spent my money. But what was your savings rate like? What was your investing plan like in those early years?
Yeah, I mean, I very early on, I mean, I made like six figures, which is pretty decent back then. This is like almost like over a decade ago.
Yeah,
But when I was homeless, right, like I just lived off the company dime for a few years there. I was saving like 100 grand a year, and I was applying
yeah,
all that into rental properties. And this
love
is
that.
like
Yeah,
early 2010. So
yeah,
that was kind of really what put me on the map. So I tell
yeah,
my folks, like, look, you can either do it the slow and steady way and save 50 grand, and after years that will probably increase because you've bought some rental properties or bought
right,
assets that produce income.
Yeah.
or even if it's something lame like a T-bill, right? Like, I mean, the same
Yeah.
premise, right? Buy things that's a little bit of income for you.
Hmm.
Um, but that you do that for 3 4 years, it'll help you grow even faster. But
You
I kind of
snowball.
turbocharged it, right? I was kind of
Yeah.
accelerating my speed by 2 to 3 years. And part of wealth building for most people is time, right? Like most of my accredited
Yeah.
investors are in their 50s,
Yep.
and it just they did it the wrong way for a decade or two, and then now they're
Right.
finally they finally have the cojones of the money to do something a little bit different off the beaten path is what it is,
Right.
unfortunately. But they all come in their own time. But this is where you need like a few years that you put 100 grand in the pot,
Yes.
and it
Yeah.
does a little bit well, and it gets you to this next pedestal. Then
Yeah.
maybe you don't have to be investing in multifamily value add or developments, right?
Right.
You can kind of go to something a lot more safer,
Right.
like closed-end funds or
Yeah.
real estate or
Yeah.
life insurance or T-bills.
Yeah.
So it doesn't take too much, right? I think the hardest part is getting to
Yeah.
a million. That's for sure.
Yeah, absolutely. And I think during those early years, what worked for us were like, you mentioned it, like some of those, I don't even know if you'd call them riskier deals, but more involved deals. Like my wife and I, we'd buy land, we'd build a spec home when the numbers made sense, and we were doubling our money pretty much every 12 to 18 months with that strategy. And that was a way. So people are like, well, how did you save so much money? You went from 50 a year to 100 a year to 200 a year. And I said, well, we started this other business effectively where we were, taking that 100 grand and turning it into 200 grand every 12 to 18 months and then saving it and taking the initial capital and doing it again. And I want to get into this. I love that you mentioned infinite banking. We've been using this strategy for, well, it's easy. It's my son's age plus one, so 17 years. And that's where we put that cash initially, and then we pulled that out as a loan against our cash value and our life insurance to buy the land that we then used as collateral to build the house. When did you start using that same strategy, Lane?
I've probably been doing it like 2015 is
Yeah.
my guess.
Now, were
Normally
you
we'll get
married?
it.
I'm curious. Were you single at the time when you did that?
Yeah, I was single at the time.
Wow,
So, and
that's
I got
unusual.
on my
Yeah.
own, and it's important to get it before you quit your day job. I mean,
Yes.
most of the
Yeah.
folks employing the strategy are trying to get the $10 million
Yeah.
policy, right? That way you can, I mean, you're not going to put $10 million or even $5 million right
Yeah.
away, but it's important to be underwritten for that
Yes.
and having
Yeah.
the income capacity to do
Yes.
that right off the bat,
Yeah.
as opposed to like a lot of people unfortunately get aged out in their mid 40s because something pops up health
Yeah.
wise.
Yeah, I want to talk about that. We've had friends who've had cancer, whose spouses have died of cancer in their late 30s, early 40s. One of the things I'm a big fan of so I got licensed back during COVID, so I could help advise our investors to merge this strategy with their investing strategy. And one of the conversations I have with people is like, hey, I don't know if I'm comfortable putting all this money in there yet. I'm going to wait. I'm 35. I'm going to wait 5 years or 10 years. And we say, well, at least look at a convertible term policy because you can get locked in at that rating. And then if something does happen, you can do it. And that is cool. That is a cool thing. You can, if you're married, you can do a policy on your spouse. You can do policies on your kids. But even kids, it's hard to do any meaningful value because the insurance company's going to say, well, we're not going to insure them for $5 million. We'll give you a $500,000 policy on your kids, and that's going to flip the funding amount, the premium amount, to a number that probably doesn't make sense. So, do you mind? I mean, I can walk through it. Obviously, our audience has heard it, but do you mind kind of walking through what the infinite banking strategy is and how you use that? So, just a quick primer here to kind of start that off. It's basically flipping a traditional whole life policy over. Instead of insuring for a certain amount, you basically match the insurance amount with the premiums you want to put in to maximize the cash value as quickly as possible.
Yeah, I mean, I've heard it explained a gazillion ways, and
Yeah.
I think sometimes people get really confused over it. I'll try and do just a different one that maybe you haven't heard of before.
Yeah, I'd love to hear
Think
it.
of it just like a home, right? Like on a home, you can pay
Love
down the
this. Love this
mortgage.
analogy. Yeah.
You can get a HELOC on the home. So no
Yep.
difference than in case you're buying a life
Yeah.
insurance policy, which in reality is a lot more secure than a piece of property that a hurricane can come down.
Yeah.
The important thing is to go to larger AAA rated carriers, right? Like Penn or Guardian.
Yep.
I've got Emeritus too, right? I've got several.
Yeah.
So, as long as you go to the big guys, you've got a pretty asset, right? So with this
Yes.
policy, you have the ability to kind of pay down or add money into it or fatten it up. And this is where the
Yeah.
concept comes in of being your own bank, putting money into it. So
Yeah.
when times are good or you're fat with liquidity, like maybe you sold a property or you cash out a deal, you have the basket or the capacity to put the money
Yeah.
in there. Again,
Yes.
using the analogy of the home, you're paying down your mortgage, right?
Yeah.
Knowing very well that maybe next month you're going to go into a deal 100 grand, you take a loan from the policy, just like you're taking a loan from the HELOC. No different.
Yeah.
It's actually a lot easier. It's a lot more,
Yeah.
from a credit rating, a lot more secure from that point. I think these
Yeah.
policies, if you go with the big guys, they've been paying since like the Civil War or something ridiculous like
Oh
that.
yeah. It's like, yeah, it's longer than the tax code's been around. It's incredible.
Yeah, you got some tax benefits there too, but it's kind of negligible in my
Yeah.
opinion. I think of it as like for wealthy people, it's a way of kind of storing your cash and making a little net yield on it.
Yeah.
For business owners, I work with a lot of business owners, and personally, what I do myself is, you store your reserves there. Some people
Yep.
are like, at hell or high water, I need to pay my team, so I might stick
Yeah.
that, 6 months of salary there for
Yeah.
them, just come hell or high water, and I just
Yep.
won't touch it. But everything that that they kind of float that and use that
Yeah.
to go into deals as they fill up, right? I
Yeah.
mean, I don't know very many people that can save up 100 grand every single month going to a deal, right?
Yeah.
Probably at that point they should probably be writing $250,000 checks. Then it
Right.
takes them a little while to do it. But
Yeah.
this is that mechanism for like where I don't know what you would call it, short term or mid term liquidity to
Yes.
put it there and take it out. But again, everybody uses these things a little bit differently. There's an ecosystem out there that uses stuff to pay their mortgages and debt.
Yeah. Oh yeah.
These are more of the fat fire or the fire movement people or the get out of debt world people. So they're using the same tool. The tool is configured a little bit differently, and the usage is a little bit different.
Yeah. No, I love it. And yeah, it's really become the cornerstone of our financial foundation for our family. If you're listening, you're like, hey, I want to learn more about that, you can check it out. We got a webinar, nextlevelincome.com/banking. Become Your Own Banker by Nelson Nash is a great book to read as well. As you mentioned, Lane, kind of becoming your own bank, your family bank, and doing that. We've used our policies for everything for, buying lots to build spec homes, loans during COVID, for liquidity. Helene hit Asheville, North Carolina. We needed liquidity for that. It's interesting. It's hard to charge rent when you can't provide utilities because the city has no power or water. Learn that the hard way during Helene here in Asheville, North Carolina. But yeah, it's an amazing source of liquidity. And then, like you said, when you partner it with a investing strategy, you can park your cash there. And we've even seen people use it. This is our plan to pay for college for our kids, where they can use that liquidity to borrow against, and then ultimately fund their own policies that they can go use and start their own business, buy their own real estate, and really kind of keep that flywheel going within the
Right.
family.
Right.
But I love that analogy, which is just like buying a home. You build equity, you can borrow against it, but it's easier. We had all our lines of credit with our HELOCs get cut during 2008, 2009, where you don't have that with life insurance, which is awesome. You've so you started off kind of like I said, the old fashioned way, doing residential, these turnkey rentals, buying at a really good time in the market. You're getting like 1% every month in rent for what you were paying for the properties, which are phenomenal metrics. When did you convert to commercial real estate?
Yeah, so in 2016, I kind of followed the breadcrumbs, and I was like, well, I think I was in my like early 30s at the time, and I was like,
Yeah.
well, maybe I just, what's more multiple single families? Oh, multifamily. Okay, apartments. Okay, let me
Yeah.
try this out, right? So, and I didn't have a wife at the time, so I just put down a whole bunch of money to all these silly programs
Okay,
out
okay,
there
okay.
that
I
you
gotta
see.
pause. Sorry, I gotta pause. When did you get married? When did you get married?
I think right before the pandemic. Yeah, yeah. So not too long ago.
Okay. All right. Okay, now I know. Okay, so 2016 you go into multifamily.
Yeah, Yeah, so I knew that window was closing, right, for me to make these reckless decisions, right? I mean, rental properties is one thing, right?
Yeah,
That's somewhat secure in my opinion. So those are
yeah,
investments. But
yeah,
paying for education, yeah, it was like before that point, I was just like a introverted hermit. I was like, no, I'm gonna just do this myself, right? This stuff is working. I just buy a property,
yeah,
1% down payment, cash flow, a few $100, rinse, wash, repeat. I'm the smartest person alive. Certainly was the smartest person in my cubicle world. That's for sure.
yeah,
So I started to get involved in these larger deals, and I just wanted to be a passive, right? Because I'm out in Seattle,
yeah,
and I wanted to learn how to underwrite the deals,
yeah,
and I think that was the hardest part, right? Getting started is like what people don't realize is like hundreds of people enter these programs and spend like 50 grand, and like early 1% of them are even successful because
yeah,
the barrier is like getting the deal, right? You gotta
yes,
kiss the broker's butt, and then they just send you garbage,
yeah,
and you have to stick around for 2 years kissing his butt, taking him out to lunch, and
yeah,
maybe you might get lucky if you're not one of the 20 people who are still around, also kissing that broker's butt.
yeah,
That's the hard part, right? It's an
yeah.
unfair game, if you ask
Yeah,
me.
kissing the broker's butt, cozying up to the owners, and hopefully getting
Yeah,
being you go into best and final. It's like, well, why me? Oh, well, we liked you better. We saw this or that. Yeah, it's definitely part of the game, and it's challenging, right? You got to find the deal, you got to have the money, you got to have the reputation. We JV'd our first deals. We were chatting before the show to get some of that credibility. And actually, that group kind of gave us that deal because they had another deal that they were going after that was bigger, and they were like, "Well, hey, we'll JV this deal with you guys, and you can take it over." So that was our foot in the door. So I think I think that's a great lesson that you talk about. If you're starting off, find somebody that you could partner with, that you can piggyback off of, and say, "Hey, what can I help you with? What can we do? Can we JV?" I think even if you don't make any money on that, you get that under your belt. Now you go to the broker and you're like, "Hey, we got this deal." And you're like, "Oh, okay." Then at least maybe they'll return your phone call at that point, right?
yeah, yeah. At least you can play. I mean, the game that I was gonna play was like, okay, let me just pass investor because that's what I wanted
Yeah,
to be initially, right?
yeah,
And then you're able to play this game where like, oh yeah, I'm in 1,000 units, right?
yeah,
Yeah, as a passive investor, but the doesn't know the difference.
right,
Then sometimes they don't care either. Um, but yeah, I mean that's how I mean initially like it all kind of happened at the same time, right? It was kind of like I was over with these single family homes. They're just a pain in the butt
yeah,
and high liability, and I just started to start to invest 50 grand, 25 grand, 50 grand in these deals, and maybe the first 15 deals I went into, like a few of them were like, oh shoot, I shouldn't have done that, right?
hmm,
But when you're getting started, and especially when you're around these types of newbie investor camps, they're
yeah,
just unproven operators, right? I mean, personally, I don't really want to work with anybody under a billion in AUM,
yeah,
or at least several dozen deals.
right,
And
yeah,
but that's fine if you want to chase newbies and get a 90-10 split. By all means, right? That's just your investor criteria. It's just mines these days. But
right,
I started to realize that yeah, I probably shouldn't have invested with that person, right?
mm,
And then I was like, these guys aren't super like sophisticated. A lot of these guys are not engineers. They're just entrepreneurs. And when you really dig
yeah,
into their like LinkedIn, when you go on LinkedIn, it's like somebody who has, uh, you know, no job and calls them a CEO of their own business is a dude who can't find a job, right? Like, let's face it. Not saying that college
unemployable.
is everything.
Yeah,
Not
yeah.
saying that college is everything. I
Yeah,
certainly
you're
don't
looking
think that
for a
that's,
track record, proven success, right? Proven
or at least
success.
somebody can
Yeah,
something out for 4 to 5 years and
yeah,
pony up the money and stick to something at
yeah.
the very very least is what a college degree tells me.
That's right. Yeah, I forget if it's Elon Musk who said that. But yeah, it's one of the interesting things is people that go to college, colleges really they do a good job of selecting people that have traits of success. I think I don't know. I believe that most of the people that go to college would probably be successful. You'd probably be successful whether you went to college or not, Lane. But colleges are like, oh, okay, Lane is going to be a successful person. We want him to come to college, and then yeah, college is basically a measure of hey, can you actually operate in this structured world and continue to be successful, develop relationships, do these things outside of class, and then go in the real world and continue that. So that's a good point you make there.
Yeah, I mean, it's sort of a tangent. I think college is just a mechanism in society to
Yeah.
rate people and, separate, the good or better people from others. Because
Yeah.
me and my spouse have this conversation all the time.
Yeah.
We're like, well, what does that person do for work? What is their role? And it's like, and they get paid how much? That's super easy. I'm like, well, yeah, that's why there's college, right? To differentiate. If not, everybody's gonna line up to be a doctor. Everybody's gonna line up to be a lawyer, right?
Right.
Like you have these
Yeah.
people who are just totally inept at doing stuff like that,
Yeah.
trying to get to that job, and it's like society would function that way,
Yeah.
right?
Exactly. Yeah. You got to
It'll
do the
just
work, and you got to have a system where people can prove themselves that they will actually do that. I think that's why I always love to hire athletes because like elite college, pro level or military, hired a lot of people, special forces. It's like, hey, you can operate in a structure, you can work with a team, you can demonstrate, discipline, delayed gratification, and you can do it over a long period of time, and you can endure hardship. I had one of my favorite employees, we're still friends, was a Green Beret, and we'd be in the OR lane, and it'd be a really tough case. Maybe the surgeon got upset, or things were challenging. And yeah, I remember walking out with him one day. I was like, "Hey man, it was a tough day. Did a great job." And he just turned to me and he goes, "I wasn't shot at today." I said, "That's the kind of guy I like to have on my team, right? His bar is here. He's like, if he didn't get shot at, it's not that stressful, It's like
yeah,
that's what I'm talking about."
yeah. I mean, I'll just say that you want to look for those indicators of success, right? I mean,
Yes.
that's why like there's for people who are in second generation wealthy families, third
Mm.
generation, they always say like you never give your kids the keys to the business until they've
Mm.
been hired or promoted twice in a regular job,
I like
right?
that. Yeah.
Ideally, a Fortune 500 company, not some
Yeah.
schmuck company out
Yeah.
there, right? Promoted twice,
Yeah.
but and not enterprise rent a car too, right? They just promote people just to keep them there, I'm happy, but um, yeah, like you're looking for that pedigree, right? But when
Absolutely.
I think from an investor's point of view, I mean, I think you just kind of look for people's like AUM and past track record of success. Or at least that's what I did, right? Like
Yeah.
when I was trying to pick JV partners to go into deals with as a general partner, I would look for those indicators, right? Because that's all the
Yeah.
people I have, right? That was my level,
Right.
right? But as you climb, the deal level flow, access to more and more people, they introduce more people, then
Yeah.
you bring more value, so you have a better pick of people, um,
Absolutely.
which is really weird. Like dating world does not work like it's a free for all, right? In a way, but like in the business world, there are pedestals, there are networks, there's a
Yeah.
way to negotiate, navigate the room to get better deal flow. So,
Yeah.
so when I was first starting out, so 2016 to 2020, yeah, I was just getting stuck with guys who had than 200 $100 million of assets under ownership,
Yeah.
and yeah, it wasn't that good, right? Luckily, it was a good time, right, to invest,
Yeah.
and that's part
A
of
great
this,
time.
right? any
Yeah.
any dummy can guess when rents are, you buy property and the rents skyrocket 5% that year,
Yeah.
and everybody looks like amazing, right? And you saw
Yeah. And
this
cap rates are
in the
going down, 25, you know, basis points a year. It's like, okay, this is great.
yeah,
You know?
yeah. I mean, normally, like the way it's supposed to work is cap rates come down a tenth of a percent every year. So you have this effect where every 8 to 10 years it kind of goes down a full percent, and then you have a correction, and
Yeah.
then it does it again, right? I mean,
Yeah.
that's how it
Yeah.
in commercial real estate it works a little bit slower that way,
Yeah.
where the run ups or that lowering of the cap rate 10% every year is, takes the decade, right? I mean,
Yeah.
that last market cycle from 2008 to 2023, if you want to call it, that was
Yeah.
over a decade long.
Yeah. Absolutely. Yeah, absolutely. Yeah, and then the correction comes, and yeah, it's washed out as we were talking. It washes out a lot of people at that point, and that's why I think you started at a good time. I've seen it as well. Investors that have been with us for 10 years, they said, "Oh, I get it. Like I've been investing for 10 years. I invest in a deal or two a year, and you know did really well. Some of these deals aren't doing great the past few years, but now deals are coming back online.
Yeah.
They're working. I want to get to your book. I want to get to the wealth elevator. But where are you seeing opportunity in the market today, Lane?
Well, it's certainly not going to be in the markets with the high supply. I mean, those are the Phoenix, Houston, or not, Phoenix, Austin,
Yeah.
Vegas.
Yeah.
I mean, those are
Florida.
the markets I
Yeah.
think that there was a lot of buildup there, and it's still working its way through the system. I mean, I wouldn't go into those markets in the next couple of years. I think today the opportunity is more of the tertiary markets where you didn't have any development in the run up,
Yeah.
after 2020. So, but then again, you can't underwrite your deals for more than 2% rent increases per year on those
Right.
markets too.
Yeah.
But it's hard, right? Like it's hard to make the deals pencil. I mean, everything has gone up in pricing. Like we bought a 300 unit in Houston in 2020. The rents, the taxes were 150,000 a year. Today it's over 400,
Yeah.
and it's just excuse me, phenomenal how much these things have increased.
Plus inflation, plus wage growth. I mean, we're seeing 25, 30, 35% higher expenses in those markets, plus the insurance rates are higher, plus
Yeah,
rent growth. Rent is stagnant or maybe very, very slight at this point. Yeah, it's hard to make the deals pencil.
yeah. I mean, I've seen some insurance come down a little bit, but it's still higher than what it was in the pandemic
Yeah.
times 5 years ago. But I think that's harder to. I mean, the big thing is interest rates. You need the damn interest rates to come down. Real
Yeah.
estate is highly dependent on interest rates,
Yep.
and if you look at I think everybody listening here should have the Chatham Financial Curve and the CME Fed Watch tool bookmarked. They don't have to insist track
Say
it like
that
I
one more
do.
time for the audience.
CME Fed Watch tool and the Chatham Financial Curve. They can just
Thank you.
Google it.
Yeah.
And that should be marked on everybody's desktops or mobile phones. And that's what tells you what the professionals who have skin in the game, these are rate cap providers, by the way,
Yeah.
what their predicted rates are, right?
Yep.
Don't listen to the YouTubers out there. They don't know what they're talking about, right? They're just doing doom and gloom. But what they'll tell you, what these charts will tell you, that yes, interest rates may come down a quarter point, half a point, whether they thought it was going to be later this year, it's probably going to be next year. But a quarter point, half a point is nothing, right? That's what gets lost in the headlines. The headlines say, oh, interest rates are coming down. BS, 0.5% ain't going to change anything.
Yeah.
And then it kind of goes off from there once inflation starts to tick up and this new supply stops hitting the market, and then rents, it's off to the races again.
Yeah.
So I think that's where you as an investor need to see what are happening 2, 3, 4, 5 years ahead, or even a decade. What they're predicting, and I'm not making this up, is interest rates aren't going to go down ever what we used to be. Maybe not even my lifetime. So I question, is real estate, like you do a SWOT analysis on real estate, and I'm sorry if this is the bandwagon, everybody invests in apartments, multifamily, economies of scale, woo, right? Like, I mean, not selling programs, are you, Chris? Like mentorship programs? Hope not.
No,
Um,
we
okay,
don't. No,
okay,
we don't have a
checking.
mentorship program.
Didn't know what
Yeah.
podcast I was on.
Yeah.
And it was
Yeah.
the multifamily millions or whatever, be a freaking millionaire
Yeah.
podcast. But
No, we're fans of multifamily, but we're also realists as well.
yeah.
Yeah,
And
absolutely.
I'm still a fan of multifamily, right? Like,
Yeah.
don't get me wrong.
Yeah.
But in the correction, I had like 80-90% of my net worth in commercial real estate, and that helped me, right? Like, I recognize I rode a
Yeah.
good wave, and I was diversified, right? Like, I think
Yeah.
that's the key.
Yeah.
Investors have to diversify your portfolio, not only in different geographic markets
Yep.
and all these deals, blah blah blah. But the biggest one is time, right?
Yes.
To help
Yeah.
you in investing, being that guy who jumps in 2021. That's like the worst time,
Yeah.
you know.
Yeah, and we saw a lot of that. It's unfortunately, like I'm seeing the inverse now, Lane, which is, 22, stock market's down, bond market's down, 60/40 portfolio doesn't perform for the first time in history. Everybody jumps into multifamily. Whereas today, stock market's up. Everybody's like, well, not interested in real estate. Markets, stock market's great. I'm going to put all my money there. To your point, you diversify. You have money in the stock market, you have money in real estate, but also, if I may add to this and appreciate your opinion on this as well, you can also, you mentioned debt, you can diversify across the capital stack. So, maybe you have a position in debt, so you're paid first. You have equity positions, maybe you have some pref equity positions as well, kind of in between the two of those. And if you're diversified across time, across geographies, across different asset classes, even if it's in real estate, and you're diversified across the capital stack, then you can do each of those does better at different times.
Right, right. So, I mean, I'm working on this in my own head, right? And like, I'm
Sure.
not getting any financial advice because I'm not a certified financial planner.
Well, and even if
But
you were, you're not going to know any better just because you have that designation next to your name either.
right, right. But the way I look at it, I think what the position I had in commercial real estate, that's too, especially for like the net worth where I was kind of at, right?
Yeah.
Like, I think I should have probably like diversified away from that.
Hmm.
Um, Now, like what we're bringing up is kind of a wrinkle to it, right? Like
Yeah.
maybe I should have diversified into the debt side of
Hmm.
deals, right? Like I certainly had a lot of preferred equity, but when prefer people understand, and this is most investors don't understand this, right? You have the capital stack from 0 to 100%. What we saw is prices come down 30%. So that means all your common equity got wiped out in a
Yep.
deal if you invested it absolutely wrong time. It got so bad that out of the preferred equity position also got hurt.
Yeah.
So the way I tell people is like think about like tooth enamel, right? We got some dentists, right? So they understand this.
Yeah.
If you don't brush your teeth for like 2 weeks, it's gonna eat through that tooth enamel a bit,
Yeah.
right? Maybe
Yeah.
20%. I don't freaking know, right? But it eats through there and it's gonna create some cavities probably after a few weeks of not brushing your
Yeah.
teeth. And at that point, that's kind of what happened, right? We saw the market decay 20 to 30%, some
Yeah.
places even 40% in
Yeah.
Phoenix. And in Phoenix, 40%, that now you're eating into that tooth enamel there. And that is analogous with preferred equity. So even
Yeah.
preferred equity positions got hammered too.
Yeah.
I've got a preferred equity, and some of it, exactly what I'm saying here, got that tooth enamel got eaten up. It didn't get
Yeah.
completely blown away, right? We're still
Yeah.
fighting. We're still in there. We're
Yeah.
still alive. But this is where, if you're on the debt side, you should have been fine. But
Yeah.
I'm kind of like, well, if the way I look at my portfolio is more of a I do the barbell approach, right?
Yep.
So like if I'm gonna go after, I'd rather not be in the real estate debt side. I'd rather take that money and go way to the easy or the low risk, low return side, T bills, life insurance, that
Yeah.
stuff, right?
Yeah.
Like
Absolutely.
I'd rather be making 4 or 5% with that than 6 to 8% on the debt side of a real estate deal. That's just me,
Yeah.
right? But I mean, I think a lot of people like to. I'm kind of lazy too, and I'd also like don't want to complicate things and
Efficient. We
have
say
like
efficient in our family. Yeah.
yeah, yeah. So, but some people like to do that. They have 10% in this, 10% in that, 10%, 10, and then they got like 10 things, and of that 10% of the asymmetric side, they got like 1% in tech angel deals, 2% in like Bitcoin, 3% in this altcoin that they've never heard before, no one's ever heard before, right? Like people get super complicated with this stuff.
Yeah.
I mean, obviously, it's definitely not the 60/40 guy,
Yeah.
right? This
Right.
stocks bonds guy,
Yeah.
that's for sure. But this is where I think like what I'm trying to guide towards this is like if you do a SWOT analysis in real estate these days, right? Interest rates is a big thing. You lost that. You lost a big tailwind to real estate. Not saying that you can't
Yeah.
do it.
Yeah.
And every deal is different, right? Like so. I mean, recently, I know I can't talk about deals today, right? Because that's illegal. But like I can talk about deals in the recent, like late last
Yeah.
year. Tertiary market deal pencils. I think it penciled because we had an FHA loan on there, and the debt was like super low, so that
Yeah.
that always helps everything. That makes everything.
You can do an
But
assumption.
yeah,
Yeah.
yeah. No. It was a brand new FHA loan, but super low debt.
Yeah.
Expenses are still high, and just all that's still high, right? But it was
Yeah.
still able to pencil, and it was just not a deal that you're looking to flip in 2 years. Like you had to kind of
Right.
stay in it for the full 4 to 5 or maybe 6 years.
Yeah.
Probably get lucky, right, with the cap rates coming down more than a tenth
Yeah.
percent every single year, more than likely. But you can't count on it. You can't underwrite the deal like that, which I think
No.
some people do
Yeah.
out there.
Yeah.
But I think that's a solid deal, right? I
Right.
mean,
Yeah.
if you're counting on the market not overperforming, I mean it'd still be a solid deal. So I
Yeah, well,
think
like
for
you, like when I started investing, I was like, hey, getting 12, 13, 14, 15%, annualized in these deals, those are solid deals. And we got carried away. We got spoiled getting 20, 30, 40% annualized over a period of years. And like you said, the market corrected. Now we're back to, it's like, hey, we're seeing, kind of bread and butter deals in these markets. Lane, I don't. We're coming up on the end of our time here. I want to make sure. I'd love for you to share a little bit about how to get in touch with you, your book, The Wealth Elevator. And I was going to ask you one other quick question, if you can if you have time to piggyback onto that. You have kids now. I'd love to hear your thoughts on, what you're doing to educate your kids and pass that baton on to them at some point.
Yeah, I don't have an opinion on whether I fly first class. Seems like everybody wants to talk about that particular thing. I got a 5 year old and a 1 year old. To me, I'm just gonna show them success leaves clues.
Yeah.
Daddy spends his time adding value to the world, has his business, and I'm just gonna kind of keep doing that, and that's why we
Love
get
that.
to enjoy this life.
Love that.
Um, if I have to buy a Lamborghini to show them and impress them, then that I'm gonna have to do. Hopefully, I don't. But there that's the hard part, right? Like this generation two, they're always gonna go to private school, go to the best colleges. She'll probably USC, right? University of Spoiled Children. And but it's the third generation that's gonna suffer
Right.
because my kids are gonna be horrible parents because they don't know how to make money, right? They don't know how to be an investor. They don't understand that concept of, oh my goodness, I have to pay 8% for a HELOC, but I could invest it elsewhere. I'm uncomfortable about this, right?
Mm,
That's where you grow cojones.
that's right.
That's where
Yeah.
you get repetitions of being an investor, right? It's waiting for that reward that comes out when you've kind of put half of your kitty in, right?
Yeah.
Hopefully,
Absolutely.
my kids will never be in that situation, so I don't know how I can expect them to build that muscle.
Mm,
But I don't know. I don't know where I'm at. Like maybe at the very least, I should be happy with them picking up the triple net check from the renter every other month. They're
yeah.
late. They got something. They'd rather hang out in the private jet or something like that. I don't know, but I don't know. I just don't care. I kind of don't care because on the one hand, I have low expectations because I feel like giving your kids more than $2 million each is just overkill. So to me, I think
Yeah.
I've kind of checked that box in my head that yeah, we'll be here. So it's like let me just enjoy my life and take them on a good time and enjoy life as it is, like live in the
Yeah.
now.
Yeah.
But yeah, it's something I'm very passionate about, right? Like how to groom the next generation to take this over.
Yeah.
That's why we do events, and I do it because I wanted my kids to grow up in a community with other high net worth people's kids, so
Yes.
it becomes
Yeah.
osmosis. Because something I've learned from my parents is I never follow anything my parents tell me, and luckily they were doing the stock market 401k stuff, so this is why I kind of rebelled to this world, the alternative investments, and as soon as I could, I got rid of my Roth IRA and my 401k stuff. That's just where I'm coming from, right? Like I'm kind of like if I
Yeah.
try too hard, they're just gonna rebel.
Yeah.
So that's kind of where I'm like, well, let me create the community and the culture and other people, and then hopefully my kids get it because they see how they
Yeah.
live versus their counterparts at school.
Yeah.
Um,
Yeah.
but that's my opinion
No.
with that. Yeah.
So yeah. So first off, I respect that. I admire that because my father died when I was 5. A lot of listeners have heard that or read it in my book, and I didn't get that experience. So for me, I really value, having experiences with my boys and being able to pour into them, and some of that is just, I'm the quantity of time is quality of time with kids a lot of time, right? You're just there, get to show up at a high school lacrosse game, whatever it might be, just be there for them. But what you said, which I really love, is I want to show my kids that I provide value to the world. I add value to the world and do that. And I think that, if we look at it through the lens, whether you're going out and getting a job and saying, well, I always tell my boys, it's like, don't ask for like what you're going to pay me. Say, hey, what can I do? Like, what is my boss doing? How can I add value to my boss, the company, the clients, the customers, who that might be? The money will follow when you do that. So I really like that rule, Lane.
Yeah, yeah, and so yeah, the book, The Wealth Elevator, on Amazon. Pick up a copy, write a nice review. They can send us a screenshot, team at thewealthelevator.com. We'll hook them up with the PDF versions. So if they're smart, they'll put into their AI and ask it little questions. And then we'll hook them up
Love
with
that.
the MP3 version, just in case they, like me, can't read too well. But yeah, thanks for having me, Chris.
Absolutely. It's been a
Yeah,
fun conversation. Yeah. And yeah, all this will be in the show notes, thewealthelevator.com. You can also get it on Amazon. You can check out Lane and his community as well through that link. Again, we love what you're doing. Love what you're doing with the community. We're all learning. I love how humble you are, Lane. It's like, hey, we all have our ideas. We can talk through these things, but really bringing everybody together and saying, hey, like what's going on, being around successful people, and then helping our children, our families be around those same successful people. Success leaves clues, and be around people that are leaving clues all over the place. So Lane, thanks for sharing that with the community here today. I hope you and your family enjoy the rest of the summer.
Thanks, Chris.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.